And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It's put up or shut up time for the SEC. They are required to give a response to ARK's application for a Bitcoin ETF, spot Bitcoin, by August 13th, with many other Bitcoin ETFs, including BlackRock and WisdomTree, just a few days behind. Will they say yes, no, or punt it down the road? Let's talk with a man who has one of those applications in. That's Matt Hogan. He's Chief Investment Officer for Bitwise Asset Management. Matt, you have also filed for the Bitwise Bitcoin ETF Trust just behind ARK. Handicap this for us. Does the SEC say yes, no, or punt it down the road?
Yeah, if you look at the history of ETF applications around spot Bitcoin ETFs, Bob, they've historically punted it down the road. In every case since 2016, they've taken up to or entirety of the 240 days they have to review these applications. These are complex applications with a lot of data. I think they're likely to extend this until the final review, which comes in January.
So if they want to push this off further, the drop dead date is January. Is that right? They can extend it again.
That's right. The law gives them up to 240 days. What this August 13th deadline is an interim deadline, sort of like a check-in. Can we decide now, or do we need more time to review? My guess, I don't know, but my guess is that they'll need more time to review, as they have in each instance in the past.
Yeah, we got a long line here. I mean, besides ARK, we have Bitwise, BlackRock, VanEck, WisdomTree, Valkyrie, First Trust, Fidelity, and Grayscale wants to convert into an ETF as well. So talking to the community and just getting a sense, they seem very excited, the crypto community, because the current crop of applicants has this surveillance sharing agreement in it with exchanges like NASDAQ and the CBOE that would allow for the sharing of information about market trading activity and clearing activity and customer identification. And supposedly this will reduce the chance for market manipulation, which is the main complaint the SEC has. It also seeks to ensure that investor assets can't be diverted by the exchanges to an unauthorized party. That was the big issue, I know, at FTX. So is this enough? Is this sufficient to address the SEC's concerns about fraud and manipulation?
It's a great question, Bob. You know, I think it's very helpful, but it's not a silver bullet. Look, what the SEC wants is for a spot Bitcoin ETF that the American public can trust, that provides careful exposure to the price of Bitcoin, that doesn't lose customer assets, et cetera. So they're evaluating a totality of circumstances. The surveillance sharing agreements between traditional exchanges and crypto exchanges like Coinbase are helpful, but it's also helpful that we've had a Bitcoin futures ETF on the market for almost 2 years. It's also helpful that the regulated futures market is large and robust and growing. It's also helpful that we have a better understanding of crypto custody, of broker transfer. The totality of circumstances is what the SEC is looking at. I don't think there's any silver bullet, but I do think if you step back and look at those totality of circumstances, we're in a very positive state. I think the market is ready for a spot Bitcoin ETF. I think investors deserve a spot Bitcoin ETF, and I'm hopeful we'll get one sometime in the coming months.
Yeah, I'm in agreement with you. There is a lot of optimism out there in the crypto community. I've heard several reasons. Some say, well, look, the SEC has just approved a 2-time leveraged Bitcoin ETF. Well, that's got to be a sign that they're sort of softening up a little bit. But the biggest thing that I've heard, which makes a lot of sense to me, is this lawsuit that Grayscale has brought against the SEC. So Grayscale wants to convert its Grayscale trust to a spot Bitcoin ETF. The SEC has denied them. And in some of the hearings, the judge seems to have been very hostile as to why the SEC has approved a Bitcoin futures ETF and not a spot ETF. Very aggressive in his questioning. I just spoke with Michael Sonnenschein from Grayscale. He tells me a ruling in the case is expected any day now. Could that move the dial if it went in Grayscale's favor?
I definitely think it could move the dial, Bob. You know, you and I love ETF history. We know that in Canada, which has spot Bitcoin ETFs, it was a lawsuit that provided the initial breakthrough that got us over the hump there to get those listed and trading. I think this would be an important catalyst. Grayscale is arguing that you can't have a futures-based Bitcoin ETF and say that there is something wrong with the price of Bitcoin that doesn't allow you to have a spot Bitcoin ETF. That has a certain amount of logic to it. And if the courts can enforce that, that narrows the window of the questions that the SEC can ask about in this space. Again, it's not a silver, there is no silver bullet, but it is another piece of helpful evidence that might help push us over the edge.
Yeah, I was very impressed with how aggressively the judge questioned the SEC in the Grayscale case. They seem to imply that the SEC hasn't really explained to Grayscale exactly why they have been turning them down. So if a spot Bitcoin ETF is approved, should the SEC approve all of them at once? What happens? Let's assume something happens. Should they approve them all at once? Do you think that should be the case?
I think there should be a fair playing field that allows us to have multiple spot Bitcoin ETFs that compete in the market. That's actually the best outcome for investors. It will allow prices to be the lowest. It will allow competition to be the highest. It will allow service to be the highest. It's what investors should want. And it's probably the fairest to the industry. There maybe shouldn't be just a lottery-based system based on when you filed and when you get approved. Let's line up the best spot Bitcoin ETFs at the starting line, say go, and see who can win the market. You know, we're confident at Bitwise that if we have the opportunity to compete in that space, we'll be able to win our fair share. But most importantly, that would be what's best for investors. And that's really what we should be arguing for here.
Well, certainly we have seen the first mover advantage in anything that's out there in the business, particularly in ETF. So this would make a lot of sense to me. And what do you make of this idea? Oh, BlackRock got in because BlackRock must know something. Or, gee, BlackRock has a great record of applications. But I'm not so sure that they're not simply watching what everybody else is watching, particularly this whole debate with Grayscale and the lawsuit going on. I mean, what do you make it when people say, oh, BlackRock must know something?
Yeah, I don't think there's any conspiracy theory. There's no whispering of messages to BlackRock. What there is the world's largest asset manager, a very sophisticated player in the ETF market, looking at the totality of conditions and saying they think the time is right for a spot Bitcoin ETF. And on the other side of the aisle, equally important, BlackRock saying we think Bitcoin is an important asset for investors to get exposure to for the next year, the next 3 years, the next 10 years. Again, I don't think there's any special conspiracy, but they are a sophisticated player. So it's another sign that the best ETF experts in this market thinks conditions have matured enough to allow the SEC to say yes, and I hope that's what we see.
And what about this endless debate about whether cryptocurrencies are commodities or not? We haven't even addressed that. Could you explain simply, Matt, and you've done this before for us, why is Bitcoin considered a commodity, but the SEC contends other coins apparently are not? What is it about Bitcoin that makes it somewhat special, it seems, to a certain extent?
Yeah, it's a great question because the SEC has singled out Bitcoin and said it's clearly a commodity, and the CFTC has agreed. It's all about centralization, Bob. You know, securities laws are designed to protect investors from insiders knowing something about a company or an investment that the public doesn't. It's about, you know, let's not let those insiders pull the wool over the eyes of the investing public. But with Bitcoin, it's so decentralized. We don't know who created it. There's no single person in charge of it. It's globally distributed around the world. There are no insiders. All the information is public. And that's what makes it clearly a commodity. As you go from Bitcoin to Ethereum to other assets, the degree of centralized control increases and the question gets more complex. Eventually, I think we'll have legislation solve that. But what's important for investors to understand is that the regulatory status of Bitcoin specifically is very clear. It's a commodity. It could fit into an ETF trust. And I think both of our major regulators in the U.S. agree on its commodity status.
You mentioned legislation. What are the chances of getting congressional rules on crypto? Everybody seems to want that. It seems to be very far away, though.
You know, I don't think it's as far as people think, Bob. I've been on Capitol Hill recently, meeting both with Republicans and with Democrats, and I'd say two things from those meetings. One, the level of understanding about crypto is extremely high. Congress didn't know much about crypto a few years ago. Now they're really experts. And two, the bipartisan sense that we need legislation to provide a firm regulatory framework for crypto in America so we can compete internationally is very clear. Look, you have the two largest regulators disagreeing on whether most crypto assets are securities or commodities. The right solution there is for legislators to come through and make that clear so that U.S. innovators can win in the market. I'm actually optimistic we'll see that sometime within the next 2 years, even with the challenging sort of network in Congress we have. There is real progress there being made.
All right, 2 years. I'm going to hold you to that. Now, stay there, Matt. I want to pivot for a moment. I want to bring in a special guest, a friend of mine, legendary financial author William Bernstein, joining us now with a new edition of his investment classic. This is the 4 Pillars of Investing on how to use ETFs. Partly, I'm going to talk to him about building a long-term portfolio, but he's the author of many other books, including The Birth of Plenty, one of my favorite book, A History of the World's Standard of Living, essentially, and The Delusion of Crowds, Why People Go Mad in Groups. Bill, thank you very much for joining us. And before I get to your book, I think you were listening there to our discussion on Bitcoin. Do you have any thoughts on crypto? Is it money? Does it deserve to be considered an asset class? What are your thoughts?
Well, I think that the key term is the word itself, cryptocurrency. It is a currency. And one generally doesn't think of currency as part of an investment portfolio. It's a unit of account, but it's not an investment product per se. So I would no sooner invest in cryptocurrency than I would in, Swiss francs or English pounds and then stick them in the mattress.
And there are some people would argue that it's not money, of course, but I want to turn to your book because that's why I'm having you here today, The 4 Pillars of Investing. This book came out 20 years ago. I read it then. It's become a bit of an investment classic. Before I get to the 4 pillars, I want to let the viewers know you were a very early proponent of indexing. You were one of the champions of that. You have generally argued against stock picking and market timing. Is there anything that's happened in the last 21 years that has altered your fundamental views on this?
The only thing that's happened is I'm now 20 years older, and I would like to think I've acquired some useful experience. And one of the things that I acquired and learned both in 2008 and more recently during the March 2020 COVID swoon was that how you behave in the worst 2% of the markets probably describes 90% of your overall investment performance, because compound interest is magic. And the prime directive of compound interest, as Charlie Munger famously said, is to never interrupt it. And so that you should design your portfolio with those 2% of the world in mind.
Yeah, that's a very good point. Let's go over the 4 principles because it's important. You got a book titled 4 Principles. Let's say what the 4 principles are. So number 1 here is the 4 principles of investing. Number 1 is theory here. Risk and return are joined at the hip. The higher risk, you get higher return. If you desire safety, you have to accept lower returns. So that's the theory behind this. And of course, a lot of people understand this intellectually. They don't necessarily do it, though.
That's right. I couldn't have said it better myself. So that, risk and return are joined at the hip. And if you want a perfectly safe portfolio, you're not going to have high returns. And if you want the high returns that come with equities, then you're going to have to sustain bone-crushing losses. Hopefully, they will be temporary from time to time. And basically, you don't get those stock returns for free. You have to pay for it with stomach acid.
All right. Number 2 of the 4 principles of investing is the history part of this, and that is the markets overshoot on the upside and the downside. But there's only so many plot trajectories. Now, what do you mean by that, Bill, when you say there's only so many plot trajectories? What's the takeaway for an investor to say markets overshoot on the upside and downside?
Well, markets don't get either very expensive or very cheap without a good reason. So at market bottoms, everybody likes to say that, I'm going to buy at the market bottom, but you don't know where that is except in retrospect. And the narratives at market bottoms are really scary. It looked like in the end of 2008 that our entire financial system was collapsing. It looked like in early 2020, like there were going to be tens of millions of worldwide debts, and the markets and the economies of the world were going to completely shut down. And remember that in March of 2020, there was no vaccine in sight. All right. So the world looked very scary then. So you have to just be able to keep your discipline and understand that the expected market return has to do with the perceived risk of the market and the perceived risk of the environment that you're in. So when the risks seem very high and things seem very scary, then you have to be paid with a high expected return to compensate for that risk.
Yeah. Let's move on. This is investing pillar number 3 here, and that's the psychology part of all of this. You are your own worst enemy, one of my favorite lines from you, which is true. This goes to behavioral psychology, and people don't buy low and sell high. They do the opposite. And investors tend to be overconfident about their ability to pick stocks and about their own risk tolerance. There's a lot in here, but I want to start with that point about they're overconfident about their ability to pick stocks. If there's anything that you stood for and a number of other people out there, it's that market timing generally does not work, and picking stocks doesn't work over investing in indexes. The academic literature is pretty overwhelming on this, Bill, and how do we keep emphasizing this to the new generation, I guess?
Well, you tell people a couple of things. In the first place, whenever you buy or sell a stock, the guy on the other side of the trade isn't some dentist from Peoria who doesn't know what he's doing, all right? It's generally that person on the other side of the trade generally has a name like Warren Buffett or Goldman Sachs, and that's not even the worst case scenario. The worst case scenario is that you're trading with the CFO of the corporation who knows more about it than anybody else on the planet. And the analogy I like to use, or the metaphor I like to use, is you're playing tennis against an invisible opponent. And what you don't understand is the person on the other side of the net is Serena Williams. All right. So that's the main thing. Now, the other thing has to do with timing the market. And all you have to do is just look at the history of newsletters and market timers to see that no one, and I mean no one, consistently calls the market with even 60 or 70% accuracy. More closely, more likely, it's more like 30 to 50%, which is worse than a coin flip.
Right.
And by the way, you have to hit 70% to win, because not only do you have to decide when to get out, but you have to decide when to get in.
When to get in.
And the math of that's and the math says you have to be right about 70% of the time you do both of those things successfully, and no one does that. It comes even close.
Right. You also said investors are overconfident on their risk tolerance. That's very interesting. And this ties in what you said earlier. How you behave in the worst 2% determines what you're going to do. So it turns out people are risk tolerant until the market's down 30%. And then all of a sudden, they're less risk tolerant. How do you convey that? How do you make that into something real for somebody?
Well, I quote that famous financial economist, Mike Tyson, who said that everybody's got a plan until they get punched in the mouth.
Yeah, that's true. So the bottom line is, I think the simple way to do this is prepare yourself for, like last year, the market was down 20%. Most people were very, very worried, and I got lots of emails. Should we pull money out? And I say, if you were a long-term investor, this year is not going to matter in the next 20 years. I think that's the key point here. Let me just move on here and go to 4 pillars of investing, number 4, and that's understanding the investment business and who you're dealing with. The primary business of most fund companies is collecting assets. It's not managing the money. That's very profound. Assets under management is what matters, not necessarily managing the money. And pay close attention to fund fees. And of course, this was Jack Bogle's central insight that even when you get a fund manager who might have some alpha, that's often destroyed by the fact that their fees are too high here. So I think a lot of people have absorbed this idea, Bill. I mean, this is one of the reasons ETFs have proven so popular. How do you feel about the ETF business and its role in reducing fees, for example?
Generally pretty positive. One can purchase a lot of investment products now for next to nothing in terms of expenses, a couple of basis points. And, this was, Jack Bogle wasn't wrong about very many things, but he was wrong about his opposition to ETFs. And thank goodness that Gus Sauter was able to convince him and the Vanguard group to go ahead with their ETF offerings.
Yeah, the very few things Jack was wrong on. He was wrong about that. And Jack thought there was going to be too much trading around ETFs, and there is, but the benefits far outweigh anything else. Matt, you've been sitting there quietly. Any thoughts on this? The academic literature certainly supports the idea that market timing and going in and out of stocks is a bad idea. But there's a whole new young generation of traders, particularly since COVID, who seem to love doing this. They love doing options, too. Matt, how do you convey Bill's wisdom and history without those younger people saying, guys are all a bunch of old fogies. Doesn't matter that much anymore. Any advice, Matt? You've been around a while.
Great question, and it is true wisdom. It's extremely true. Indexing always appeals to the head, but there's always a part of people's heart that thinks they can time the market. My hope for people is they put the vast majority of their portfolio in low-cost index funds and buy and hold. And then if they have to have a small portion that they try to time the market and learn those lessons individually, that's fine. But protect the bulk of your assets in low-cost index funds for the long haul. It's extremely good wisdom.
And Bill, what do you say to people when GameStop happened? People messaged me immediately and said, aha, you see, this proves fundamentals don't matter. The company's not making any money. It doesn't look like it's going to make any money. Look at the price of this crazy thing. It makes no sense at all on a fundamental basis. And ultimately, of course, those of us who are fundamental investors believe that long term that this will play out. But you have to admit, short term, they could certainly make things a little crazy. What's the correct response to people who say, well, look at GameStop. Fundamentals don't matter that much anymore?
Yeah, almost 100 years ago, my father kept trying to convince my grandfather to invest in stocks during the 1920s. And he just kept saying, no, son, I'm not going to do it. And then finally, my father, in exasperation, looked at him and said, why, Dad, shouldn't I invest in stocks? And then he just said, you'll see. And of course, 1929 happened, and that was the answer. And so that's my response to people who are enthusiastic about meme stocks is just wait a few years, you'll see.
Well, so you broke up a little bit there, Bill, but your point was what this craziness happened in the 1920s too, and eventually fundamentals caught up with everybody. That was the point?
Exactly. Right? Yeah, that was the point. It was just a story of between my father and my grandfather. My grandfather finally, in exasperation, looked at my father and said, just wait a few years in the 1920s and you'll see what happens to all these high-flying stocks.
Yeah, well, my response has always been, the reason people buy stocks is to participate in a future stream of dividends or potential earnings that would turn into dividends. And I am not aware of any reason why that has changed over the years. But you can get groups of people to suddenly believe in other things. I don't know if you remember, Bill, but in the 1980s and 1990s, we used to have on a fellow, Arch Crawford, who used to recommend buying stocks based on astrology. So the moon was in Venus by Microsoft, literally like that. And we all sort of said, you've got to be kidding me here at CNBC 30 years ago. But he had a very large following of people. And obviously, this had nothing to do at all with the fundamentals. But I guess my point here is, if you could convince a sufficiently large number of traders to suddenly believe in sunspot activity and that was going to affect something, I guess you can move stocks for a while. But ultimately, you got to go back to fundamentals somewhere.
Yeah, I mean, that's called data mining. You can always find spurious correlations. The most famous example of that was about 20 or 30 years ago. Somebody figured out that when he plumbed the United Nations Economic Database, that butter production in Bangladesh precisely predicted the movement of the S&P 500. Well, if you're looking at 100,000 different parameters, you're liable to find one that's very accurate. But of course, there's no guarantee that's going to do terribly well going forward.
Yeah, or that there's even any correlation there, that it's any but statistical anomaly there. This has been a great conversation. We go on all day, but I got to leave it there. That does it for this week's ETF Edge. My thanks to Matt and to Bill. Now, we've asked Matt to stick around and offer a little bit more perspective on ETFs and crypto for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.